With the markets in free fall, it might surprise investors to see that Ray Dalio's Bridgewater is building a nearly $6 billion bet against European stocks. This is spread across around 18 different firms, one of which is a $1 billion bet against ASML. In this video, we're going to talk about why is Ray Dalio's Bridgewater making this big bet against European stocks, leaning into the stock market decline. What do I think of ASML? It is an exceptional business, arguably an unrivaled company, but what's the right price? And why is Ray Dalio short? We're going to talk about all these aspects and more. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. And so first of all, a big thank you to all the Unrivaled Investing subscribers who are taking charge of their financial journeys, signed up at unrivaledinvesting.com, and who also make this channel possible. So I think the key aspect that you need to consider with Ray Dalio is that he not only looks at companies from the bottom up, but he also looks top down. And here it is, you have the European Central Bank confirming, yeah, we need to continue raising rates because of high inflation. And this is a key aspect. I'm going to repeat this time and again on this channel. Regular viewers know I say this over and over. Liquidity moves markets. And so if you see a central bank raising interest rates, facing possible quantitative tightening that is pulling liquidity out of the market, that will pressure not only risk assets like European stocks, it will also pressure the European economy. I'd argue the European economy also is under greater pressure than, let's say, the US, because you have several different sovereign nations that have various different debt obligations, and it's harder to effectively have one central bank provide the liquidity to say, oh yeah, we'll make sure you're okay when you have to raise interest rates. You don't have that sort of unlimited money printing option to make sure everyone's interest rates don't blow up when you're in this sort of situation of high inflation. Now, why ASML in particular? Why is Bridgewater short ASML? To understand what they do, you need to understand that ASML provides lithography machines, which make it possible to mass produce the most advanced microchips possible. So what is a lithography system? It's this big box that's extremely sensitive and costs a ton. And it really, the most simplistic way to think about it is that it uses various different forms of light to print tiny patterns on silicone, which is the fundamental step to mass producing microchips. And their systems ultimately enable the supercomputers that you have on your wrist, in your pocket, the technology around you. And I would say the potential for your improved standard of living is in large part driven by ASML and the innovation that you will continue to see there. So when you think about their place in the semiconductor industry, they are providing the equipment to customers like Taiwan Semiconductor, Samsung, Intel, and these are the customers. These customers, they end up making the semiconductors and they sell them to, let's say, the key devices. They end up in the key devices that you end up buying, like your smartphone or that smartwatch, or ends up in your car. So ultimately, ASML provides chip makers with the hardware, software, and services to mass produce patterns on silicone through lithography. And they have primarily two different lithography systems. One is called deep ultraviolet, which does have competition from Nikon and Canon. However, their EUV or extreme ultraviolet lithography, this is the cutting edge technology that arguably is going to drive the future of technology when you're looking at like these incredibly small microchips, like the 2 nanometer, the 3 nanometer microchips. That's what you're looking at here, driven by EUV lithography. And arguably here, they don't have any competitors at this point. And so when I hear that there's a company that doesn't have competitors or has a huge market share with their legacy business, that gets me thinking, whoa, unrivaled company. This is very exciting. I want to learn more. I want to potentially buy, but then you always need to think about, well, what's the right valuation? Because if you don't consider the valuation, you might end up with someone like Ray Dalio betting against you. So let's see how the valuation or how this unrivaled position translates into financials. You can see around 19 billion euros in sales. That's up significantly from 14 billion in 2020. You can see juicy gross margin over 50%. That means these lithography systems are so complex, and they have such a strong position from a competitive perspective with over a 50% gross margin. That means they mark it up over 100% when they're selling it to their customers. That's how strong their value proposition is, saying, hey, we know you're marking this up a lot, but we need it, so we're going to pay it. So that's how they're able to have these juicy margins, significant profitability, significant buybacks. And to understand, they only sell like 300 lithography systems a year. So that means per system, that's around $40-50 million per system. Once again, extremely sensitive, critical systems that are very, very expensive. And here it is, first quarter of 2022, management talked about how they continue to see that demand for our systems is higher than our current production capacity. And they also talked about how they have plans to increase capacity and revisit their scenarios for 2025 and growth opportunities beyond that. So what was their 2025 outlook? Well, they talked about nearly 30 billion euros in revenue. So that's up significantly from the 18-19 billion in 2021. Now, this is really interesting. You have a company with a strong value proposition, lots of growth, great free cash flow, great, driving the future, and yet you have a major investor, super shrewd investor like Ray Dalio, betting against it. Why is that happening? So let's try to think about that. So first of all, nearly 70% of their revenue is from their top 2 customers. So that is definitely some customer concentration risk, where if one of them starts having trouble, then you should expect to see that lead to trouble for their business as well. Earlier this week, Samsung, is sort of rumored to face temporarily reduces procurement amid inventory pressure, i.e. Samsung is seeing their inventory of electronics build up. So they're telling their suppliers, yes, slow down here. We're seeing sort of a glut. And this could ultimately read through to ASML. Another key aspect that I want you to think about is security. You look at semiconductor security, the supply chain security leads to redundancy, which leads to gluts. Okay, so what do I mean by that? So when you have, let's say, what we just went through, which was a semiconductor shortage, and every country around the world goes, wait a second, a lot of these chips are being manufactured in Taiwan. What happens if we lose our supply from Taiwan? Well, we want to make sure we insource it. We start producing it ourselves. So this means you're going to have effectively supply chain security, infrastructure build out in the US, in the Eurozone, around the world, saying, hey, we don't want to rely just on one geographic region. Now, as countries around the world and companies around the world start building out, this supply chain security, it does lead to redundancy, because then they say, wait a second, we made these big factories. We don't necessarily need all this capacity for ourselves. Let's sell it to the Eurozone. And then the Eurozone's going to be thinking, well, we just built out this new, capacity. We don't need it. We're going to sell it to the US. We're going to sell it, to Latin America. And so all of a sudden you do have the potential for excess capacity and a glut in the future, which does hurt pricing potential. And so that is something that investors should want to consider. Now, what do I think of ASML stock from here? So first of all, look, ASML has had a great run for several decades, nearly $20 billion in revenue. But you should recognize that this business, it doesn't just go up in a straight line. No, I don't think any company does. Whereas the reality is this is very much tied to cycles. During the great financial crisis, you saw revenue drop precipitously. You also saw it during the dot-com bubble implosion. And with those declines in economic activity, their profit margins also collapsed significantly. And it is worth understanding that during the recent shortage in chips, where arguably they were in a prime position to charge even more, their margins went from around 20% to nearly 30%. So the question is 20% more of the normalized margin? Is 30%? Is it possible if we have a tough time, it can go negative again, as it had previously in the last two, downturns? So that is a concern that investors should want to consider. So let's view it through the lens of a value investor. What would a value investor think about paying for this business? Recognizing that who knows what's going to happen next year or the year after, but longer term, let's say 2025, sometime between 2025 and 2030, this company might generate around 30 billion euros in sales. Now let's take a 20% operating margin. We're trying to be conservative. This is in line with where it was the last few years, not 2021, but the years prior to it, before you had a semiconductor shortage. Let's assume a 15% tax rate, and let's try to be conservative investors. Let's say a 15 times multiple. Well, that gets you to around 77 billion euros in value that a conservative investor might say this is the fair value. This implies around $80 billion. Now keep in mind, these are the assumptions I'd argue of a conservative investor. This is sort of my back of the envelope of like, what would a conservative investor think about saying this is the fair value? And arguably, you might even want a discount to that, because once again, value investors want to pay below what they think the fair value is. So you might even want to see a discount to that, let's say $80 billion valuation. And then you look at the current market cap, and this is around a $200 billion valuation. And it's no surprise that Bridgewater, or Ray Dalio's Bridgewater, is shorting ASML to the tune of $1 billion, because they're looking at this saying, hey, if you have a downturn, you could see profits decline significantly. Maybe they even become unprofitable. You can see the business re-rate to a much lower multiple. Based on my conservative back of the envelope, you get around $80 billion. Even if you think I'm being too conservative, you would say, okay, $80 billion, maybe it's $100 billion, maybe it's 120. Either way, that's a conservative take versus the current valuation of nearly $200 billion. So I do understand not only why Ray Dalio is short European equities, which I talked about the macro with liquidity tightening, but also looking at ASML in particular, which is that there's still a lot of lofty expectations sort of built into it, partly well-deserved. This is an exceptional company driving the future of humanity. Maybe it deserves a premium, but it will also be very cyclical. I personally am not looking to pull the trigger yet on ASML. I might be interested when you see the next downturn and they're reporting a loss and the stock is getting hammered. That is the time where I want to think, okay, what's the long-term earnings potential, and can I get it at a discount to that? And that's the type of company that I'm trying to call out in my weekly letters at unrivaledinvesting.com. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. Thank you so much for tuning in.